Hi, everyone. Thanks for joining. This is our fifth webinar. We're excited that we have now a series going. Thank you, Marquise, for the wonderful introduction. We're blessed to have you as part of our team and excited to share today something different. So the intro for Marquise is nice and different, and the topic will be different as well. So as usual, you can type in your question in the chat box and we'll get to it. But I'd like to also keep it interactive if you have any questions. This might be a foreign topic to many of you, so I decided to kind of zoom out and discuss what is oil and gas. And we'll touch a little bit about the investment into oil and gas at the end and throughout, but I anticipate that we may need another follow-up to focus more on where we can realistically invest in this multi-billion-dollar industry. So with that, today's topic is going to be oil and gas investing 101. And we'll get started. As always, disclaimer to get that out of the way, this webinar is for educational purposes only and is not a legal or financial advice. For anyone who would like to invest in a future opportunity, please consult with your legal and financial advisor. Is oil and gas really dying? We heard so much about the the transition, the energy transition, go into renewable, go into a more balanced and more environmentally friendly energy mix. But what's happening now, especially recently after COVID and the wars in Europe, the slowdown in economic growth all around the globe, including China, the demand-supply balance has changed, and the subsidies that were injected by governments to accelerate the energy transition is no longer in play or is minimized at best. And so the economics now dictates, and the realities dictate. So I wanted to share a couple of charts with you. The first one is, the demand equation for oil, crude oil, and the demand equation for gas, which is actually getting more momentum. And what you can see here is 3 predictions until 2025. And this is actually 2 years ago. And there's a lot of updates to these curves, especially recently, where they now talk about 2070 in China and India, for example, beyond 2050, which was the target. So as you can see, demand will continue to increase over at least the next decade, if not longer, for oil and gas and beyond into 2050 and plus. And if you look at the reserves of oil and where they're at in the US and the lack of investment in the last few years due to energy transition, but also due to economic consequences of COVID and the stimulus that went to elsewhere by the governments, you can see that there wasn't a lot of investments into oil and gas, and that will create a decline actually in the production. So oil and gas is, when you drill wells and you get oil out of the ground, over time the production goes down. So if you don't continue to develop and spend development money into producing, uncovering and finding more oil and producing more oil, the production will decline over time. And so anytime there's a decrease in government spending and private sector spending into the oil and gas industry, supply will start to dip and demand will continue to rise. So that will create a mismatch, will normally create an increase in the oil price. In the US alone, today, the US is actually the highest producing country in the world, believe it or not, completely self-sufficient. But that won't last too long if they don't continue to invest in drilling more into the US. And we believe that in the next 5 years, the production will significantly decline in the US. So if there's no more drilling in the US, the production will decline and there will be more dependency on foreign oil. And that equation happens globally. Whether it's Saudi Arabia or in the Middle East, Africa, and the massive reserves in Africa, even in North Europe as well, same equation. So bottom line, supply is declining because there's not a lot of investments and demand is continuing to increase. So we don't see oil and gas going away anytime soon. And we think it might be even going beyond 2050. So we hear about oil and gas. Oil and gas is three segments in the value chain. Upstream. So upstream is anything from exploring where the oil is. And the geologists and the geophysicists go study where the oil is, perform seismic surveys. Seismic surveys is, if I want to simplify it, the best analogy is like an MRI of the ground. You see the layers of the ground, the layers of the sand, where the oil can be trapped, the gas as well, and you produce this image and survey of where we think the oil is, and from that, the drilling process starts to find these wells, drill wells where we think the oil is, and then prove that the oil is there. And then from there, they start producing the oil from the oil wells. And when I say oil, oil and gas together, and go through that process of producing all the oil that we can produce out of a single well or of a single field. That's a production phase. And then maintaining those wells and redeveloping these wells and making sure that they continue to produce until they're economically, as long as they're economically feasible. So that's upstream. Upstream is where we find the oil and extract the oil in a nutshell. Then there's midstream. Midstream is in the middle, is where we transport the oil from the field to the ports or to the pipeline or to the trucks. The process of storing the oil and the process of distribution as well. Whether it's processing natural gas and compressing it and refining it, or distributing it across different refineries across the globe or within the US. So that's midstream. So you'll hear about upstream, midstream, and then downstream. Downstream is where we actually use that oil. And so we refine that oil into the different products, such as gas, diesel, fuel, asphalt, etc., petrochem. And then we go into the retail, where you can actually buy these from, the marketing and the distribution on the retail. The derivatives that are the plastics, all those fertilizers and rubber and synthetic materials that comes out of the petrol, and all the petrochemical products that comes out of oil. And then finally, the LNG production. So those are the three segments. That's funny enough, because I spent time in oil and gas and I was consumed with the stream analogy. That's where InvestStream came from. So just giving you that.
Oh, real quick,
Yes.
because I know some of us on the call don't have the background in oil and gas. To summarize what you shared with us, you're saying upstream is the extraction of the oil and gas. Midstream is generally the transportation of that. And then the downstream is kind of when it's transformed into an end user product, like crude oil for jet engines and heating and that sort of thing. Are those kind of the three stages?
Yeah, absolutely. That's a good summary.
Perfect. I was asking for my friends in the back. Thank you.
Thanks. So that's a huge multi-billion-dollar industry. Each industry is segmented into multiple industries and multiple service companies and investment opportunities. But what I want to focus on is a little bit on the upstream side, which is the process of finding the oil and extracting the oil. So there's generally two fields in this area. One is a green field, where we go to a place where oil wasn't discovered, or it was discovered but not extracted. And those are the green fields. So if you look at the value chain and the risk associated with it, we move from an area where we think there's oil and there are some studies that were done that they think that potentially there is oil given the geological nature and layers and the traps around in that area. And so we move from this uncertain potential of oil into, okay, now we think there's oil there, and we're going to actually invest money to drill wells to prove that the oil exists where the data is telling us it is. And that's what we call proven potential. We haven't extracted all of it yet, but now we prove that the oil is where it's supposed to be at the volumes we anticipated it would be, at the production we think it should be. And that's what proven potential is. And then we move into realized potential, which is actually starting to produce that oil and invest in scaling the development of the field, whether it's drilling more wells and building the infrastructure, et cetera. And so, if you show up to a project where you have a study, but you haven't drilled a well, that's very risky project, but high reward as well. As you move into the value chain, the risk will decrease, but the reward as well. So the first step of that is the seismic survey and the geological studies. It's basically our ability to create an image, 2D in the past and now 3D recently, to create an image of the underground, to understand the layers of the earth, where the rock is, where the oil potentially would be, and the gas traps are. And that's done through a seismic process. Then that data is using AI and using data processing techniques and tools is transformed into an imaging process of the ground, basically. And so you start looking into the imaging. We start looking into the data that was extracted from the producing wells. The data was extracted when drilling wells in the nearby, and combining all that data together. Kind of the analogy for the doctors on the call. You have the MRI image, and now you're performing a surgery to confirm and to extract a tumor or to perform a procedure. So it's a combination of data from the surface and data from the subsurface combined with data analysis and AI that completes that picture. So there's a lot of companies that specialize in this field, and that's an area of investment on its own. It's basically go do the imaging, study where the oil could be, and sell those studies to companies that would go invest in it. That's one investment type within upstream. The next step is to actually go drill an exploratory well, whether it's offshore or onshore. And those are typically, it depends on how many prospects we see in that field. You'll go drill a well or two to prove that specific prospect. Or sometimes you drill the first one and then you do another well to appraise and understand how much reserves or production levels they would be from that field. So that's the second phase, and that's an investment on its own. If you have the studies and now you're taking the risk after you analyze the data to go drill and prove that potential. So that's another investment opportunity, a little bit lower risk because now the geology has done all of the work. And, sometimes it's anything from 60 to 70% certain that, yes, you'll find oil in that area, but sometimes you go drill a well and the oil has escaped from that trap. So it might have been a perfect geology, but the oil was not there, or the gas was escaped as well. So that's a risk associated with exploratory drilling, is we understand the data, but we now physically have to drill and invest money and find that oil and confirm the levels that were anticipated. And I would say the first two are relatively not that expensive. They're in the order of magnitude of millions of dollars. So, performing seismic analysis, performing data analysis, and drilling wells are in the order of magnitude of millions, tens of millions of dollars. And those are the two phases in the upstream. The third phase is now developing. Okay, now we found the well, we found the field, we've proven that potential, and now we want to scale. And so There's different ways of scaling. There's the California old school of Bakersfield scaling, where they have a well every 50 yards. And this is a picture from West Texas. And there's the Middle East, Saudi type of billions of dollars of development and infrastructure building. So this is now drilling a lot more wells and building the infrastructure to gather, process that oil before it's transported. So that's the development of infrastructure. Here, the risks are much lower, but the infrastructure cost is much greater. So we're now talking hundreds of millions, if not billions of dollars of development money, lower risk, but higher capital, capital expenditure to build these, develop these fields and scale what's already proven. This is government scale, big corporation scales, and a combination of two in most cases. So that's a third element. And then we go into the brownfield. So now, okay, we found the oil, we're now developing it, we're developing the infrastructure, we're extracting the oil. Over time, the oil production will decline. So we get into the brownfield phase, if you will. And the brownfield is how can we produce more of what we have? How can we recover the maximum oil out of these fields, extract the maximum oil? How can we redevelop the existing fields to produce more oil of what we have and then optimize that production? And the risk equation here is inverted. So early on, you have a lot of oil and you're just producing it and it's sweet oil. And over time, you now need to inject more technology, more equipment, redevelop these fields, drill more wells, maintain those wells, and now try to optimize that production so we can squeeze. A lot of the time, and you'll see this in the next slide, we can't recover all of the oil from a certain technique. So you have to apply different techniques over the life of a field. And a life of a field can be anything from 20 to 50 to 100 years old. Like it can be really a long time, especially it depends on the size of the reservoir and how much oil can you get out of it. But we're talking about tens, if not 100 years worth of production from certain fields. But the risk is the other way. As we have less oil, it becomes more risky to inject more capital because everything needs to be now calculated precisely to make sure every injection of capital will have the right return of oil.
So there I come again, just to interject for my
Yes.
friends in the back, right? ABCs. So with this greenfield, if I understand correctly, there are the three phases to that. There's the imaging first, then you get a sample of it, and then you move into the actual development of it. Is that kind of sums it up?
Yep.
That's perfect. That kind of reminds me of how I choose my food. I'll be honest with you. I know we're not talking about that, but I usually look on Yelp, like to get the pictures, the recommendations that people have, the proven systems, and then I like to get a sample from them. And once I know the sample is good, I'm like, hey, that can go to my top 10 bakeries, like Tiny's Milk and Cookies in Houston, shameless plug. But okay, that makes sense. Sample, image, sample, explore.
Great.
Nice.
Now then you can invite your friends.
Right, right. And we're moving to the brown stage, right?
So yes, can we get all the cookies in town, basically? And that's kind of the brownfield phase. So the first section, there's two steps of this brown field phase. The first one is enhanced oil recovery. There's three production curves, if you will, for any oil field. There's a primary production, which is you drill, the well's already pressurized. All you need is to put a straw, if you will, in the ground, and the pressure is high enough that the oil is just going to gush out. That's primary production. And as you can see here, it goes up because of the development and all drilling more wells and developing that field. But with time, that will decline. And if you don't do anything about it, then you can't really recover most of the oil in the field. The secondary production is when you introduce different techniques. We call it improved oil recovery. This is where we have injection wells injecting fluid, water, for example. So we'll drill more wells around the production well to push the oil in a way into the production well. That's an improved oil recovery. And then you move into artificial lift, which is other ways of putting machinery to actually put in a pump, for example, downhole to push the oil up. You can use hydraulic injection, you can use gas injection, etc. So over time, you start coming up with creative ways to get most of the oil in the ground out of the ground, whether by injection, any stimulation process, basically. So that's what we call enhanced oil recovery. And so that's another investment on its own. You go to a field and now you're introducing new technology. You're drilling more injection wells to get more oil out of the field. So that's an investment on its own. There's a heavy capex, again, billions of dollars to drill these wells. But it's also, it's in the US, for example, this can be an achievable investment for let's say in the order of magnitude of millions of dollars. And then finally is the last phase before the well is shut and the field is abandoned, is maintaining those wells, continuing to inject capital into the infrastructure, the well maintenance itself, the infrastructure maintenance itself. And more importantly, and actually this was my career in oil and gas, is production optimization. That's all I worked on over the years, is that improved oil recovery and enhanced oil recovery. And there's a lot of technology that has been deployed in this area, but in a summary, you get real-time data from where the oil is being extracted. You understand the reservoir and you build a digital model for we call it a digital twin. And now you're managing the entirety of the field in terms of production. You're not producing from one well. You're managing where you're going to inject and where you're going to produce and which wells you're going to speed up and which wells you're going to slow down and how you're going to manage all the pipeline constraints to get basically the maximum oil out of the ground. So we always said we're going to get more oil out of what we have without drilling additional wells. So that's the last phase, production optimization. And then the final thing is they shut down the wells and they abandon the field. Okay, so I'll pause here. There's a lot of information, but the main thing for us really is this is everything oil and gas. Now, why does it matter? Where is the opportunity for me and you outside of buying a stock with the big international oil companies? And I believe the sweet spot enabled by syndication law in the US, enabled by tax laws in the US, it helps everyday investors come to these three areas, and the sweet spot can be a combination of these three or a combination of two of them, is where the geological studies on its own is spending the money where we think oil is and selling those studies, combining that with drilling few wells as exploratory wells to prove that theory, and then sell that to a bigger developer that don't want to spend much of the time doing the exploration and the testing. So that's one area. The other area is actually taking a small field and continue the development and scaling that potential before you sell it to even a bigger company. So that's where I believe the sweet spot is a combination of doing the studies, doing the exploration wells, and doing early development. And these kind of projects can range from anything from maybe 10, $20 million all the way to $200-300 million. So that's where we think the sweet spot is for individuals that can chip in 100,000, 200,000 into a syndication or a fund to develop a field here in the US or even sometimes elsewhere, like in Africa most recently. So I'm going to try to simplify it even further and compare it to multifamily. So multifamily apartment complexes, we work in this market day in and day out. We either buy multifamily properties and add value, enhancing the property itself, injecting amenities, increasing the revenue out of it, and then exiting. Or it can be the ground up development like our last two projects. So we start with market analysis in multifamily. We want to know where to build, what lands are relatively affordable. They're not like midtown or uptown. We like the suburbs development. Do we have the right demographics, the right economic drivers in that market and sub-market that will give us a good level of rent, which will ultimately translate into income. So that's the market analysis of a real estate. We understand the land cost, we understand the rent and the construction costs, and we put that whole analysis together to develop a property. In oil and gas, it's the geology and the discovery. Doing the imaging that Marquis talked about, understanding where the oil is, and drilling a well or two to prove that. So that's a market analysis. The risk associated with oil and gas is in multifamily, typically rents continue to go up with time and valuation of a property continues to go up with time. That's appreciation. With oil and gas, oil price is typically high, but it does swing with demand and supply. And so you have to actually take a closer look at the demand forecast for the globe and locally and the supply and where we believe the oil price would be in the next 5-10 years, which is typically what we aim for when we do a project. Okay, we now understand the oil. We think it's a good project. Let's go. So we're going to have to, in the multifamily, we buy the land, we secure the land, we build the team, we hire the GC, and we build the apartment complex. In oil and gas, it would be the same. We go secure the land via a lease, or we get the rights to that land over 10, 20 years. And we hire a service company to drill and finish the wells and build the infrastructure. So that's the analogy there. And then from there, in apartment complexes, we start the lease up process. So we end up making sure that we have 80 to 85% of our units are leased and we have occupancy as maximum as possible. And we create a maximum value for the next buyer. And typically our next buyer would be an institutional money, private equity. They want to place their capital in a cash flowing property. They don't want to mess with analysis. They don't want to mess with construction. They don't want to mess with marketing. They just want a cash producing property that they can hold for 5 to 10 years. In oil and gas, it's the same equation. Once we've started the production and we've proven the reservoir and we're now flowing with cash flow on the production side, typically that's when a bigger company comes in and say, okay, thank you for all of that. You saved me X dollars, you saved me X years. I want to take it from here and develop it further. So typically an exit in oil and gas goes from the small operators into a medium to a larger operator in the oil and gas. I'll pause here and I'll start taking questions. There are a couple more topics quickly we can cover, but I think it's a good time for people to jump in.
Just gonna play the devil's advocate here.
Sure.
And again, my information is probably based on my reading rather than from a true knowledge like you. But if you notice today, the price of gas is about like $78 or $80 a barrel, which
Right.
really has not changed a lot over the last probably 15 years. I mean, it goes up and down, but not to the point that it's dramatically more expensive. And as you said, renewable energy is not going to replace gas soon, but I think with time, we're going to see more renewable energy and we're going to see less and less gas. Also, one other factor I think that can affect the profitability from gas is how easy you can extract the gas. I know from reading, and I might be wrong, drilling in the United States is totally different than drilling in Saudi Arabia. I think you have to dig deep. It costs you more money per barrel to extract gas here comparing to elsewhere in the world, like Libya or Saudi Arabia. On the other hand, also the quality of oil itself differs from area to area. Where you have some sweet crude in certain parts of the world, you might not have the same thing elsewhere. So do you know how would these factors really affect your profitability? I mean, how much? I mean, again, at the end of the day, you're going to be selling probably barrels. And again, I'm just wondering, is that really something that for the next 20 years we're talking about, other than getting really a huge tax benefit, as you alluded, is that something that you think that is going to be lucrative for people to chip in large amount of money?
Right. That's a great context. So in the US, if you compare it to the rest of the world, and the future is in Africa, so if we want to compare it to the Middle East and Africa, the US, we're really skimming. We're in that last phase of enhanced oil recovery, right? We're squeezing every last drop. But given the geopolitics of oil and gas, and given that the oil production will actually dramatically decrease in the US, we see a huge wave of investments. Now, some say, if we have another Democratic administration in the next election, that they might still curb on new drilling permits. But actually, the most drills we had over the last decade was during the Biden administration, because they realized that they need to continue to explore whatever is left is in the US. So if you compare it to, the easier oil internationally, yes, it doesn't sound like a great opportunity. But within the US, the opportunity to explore, drill, and skim, let's say, whatever left of oil here is still significant. There's huge activity of drilling and investment coming in, and will continue to. Now, we're not talking 30 years and 40 years here. We're talking about 3, 5, 10 years of window that we think that this is still going to be relevant, especially after COVID and after what happened to Europe with the Ukraine war. It just changed everything again. And with the economic downturn, everybody wants to now look at oil again. So there's a delay of energy transition. That's one. Number two is the US production is going to significantly drop over the next 5 years if they don't drill more wells. But your points are spot on in terms of comparing it to the global scheme of things.
I just have a quick question, Al. Thank you so much for your presentation. This is Nasif.
Of course.
So do you guys have like a specific scenario in mind? Like we have a group of let's say here 20, 30 people. So what's the expectation? What's your aspiring goal? What's the likely scenario in your mind?
Right. So the reason I didn't share anything, so we're working with a couple of groups on upcoming projects here in the US. So I'll leave it to that, but it's in that area that I was telling you about. It's kind of like in the Texas area, and in that sweet spot of finding these spots that people overlooked over the years because they were chasing bigger fields. So I would say that's kind of what we're looking at. It's going to be in the 20 to 50 well development projects kind of criteria that we're working on right now. But at this point, we don't have anything to offer yet. I just wanted to introduce a concept as we were working on a couple of projects since the beginning of the year.
Ala, I have a question, if you don't mind.
Yes.
Can you tell us about the tax deduction benefit for a W-2 employee if they invest in gas and oil?
Yes. So investing in oil and gas and in agriculture is about the only investing mechanism where you can take depreciation from the development of these fields and use it against your active income. So that's oil and gas and agriculture. Most of other asset classes, you can't actually depreciate development anyway. That's a construction and the development aspect. You normally depreciate real estate as passive when you acquire an existing property. And you cannot really offset W-2 with because it's passive income. You can only offset passive gains with real estate. In oil and gas, the development cost, the indirect development cost is completely, you can depreciate that and use it in year one against your W-2. And you continue to depreciate the actual direct cost over 7 years. So if you invest, say, $100,000 in year one, you might get 50 to 60 negative paper loss at the end of the year. So that's an incentive people take advantage of investing in. And this is basically the tax law, the tax code incentivizing further development of oil and gas within the US. This is a very ancient law that they continue to renew.
Great. We've got one question in the chat. I think we covered a lot of the tax benefits with your latest piece of feedback. And then just questions about the details of the buy-in process, which I think you're getting more into.
Yeah, so we talked about the tax, we talked about the risk and reward. Obviously, reward in oil and gas is higher because it's a higher risk, understandably. And typically we've seen rewards that are 2 to 3 times the level of what we see in multifamily investment, for example. But again, it depends on the project. Like I said, if you're in a exploratory, if you're drilling wells or if you're developing wells. But in general, it's a relatively higher risk, higher return with offsetting the income as a big incentive from the US tax code. So like I said, I don't have any project at this point, but typically we will show up with a project just like we would do on all of our investments. We'll share with everybody in our distribution list the opportunity as they come along. And you would sign into the portal, our portal, and from there you sign the agreements, documents digitally. And once we approve that, then you can wire the money or even use the system to transfer the funds. We typically will take that fund and will produce, depends on the project, monthly or quarterly operational updates and financial statements on every project we have. And then at the end of every year, we produce the tax documents to all of our investors, typically in the March timeframe, March-April timeframe. So that's the process. It's we send you the information about the project. We'll have a special webinar for that investment opportunity, go through that digital signature process, sending the money, and then kind of sit back and get the updates from us and the tax documents. And ultimately, when we finish the project or throughout the project, there will be the distributions. Typically, we do quarterly distributions. And then at the exit of the project, it will be the big payday of distributions. In real estate, if we're buying a business, a property, a multifamily apartment complex, typically year one, there's no distributions, and then we start distribution in year 2, year 3, year 4, year 5, and then the big exit after 5 years. So our projects of acquisitions are normally 5 years long. Depends on the market, but we try to project for 5 years. If we develop real estate, it's normally less. It's normally 3 years. No distribution in year 1 and 2, and then the big payday when we exit the property. Oil and gas is a mix of the two. There is typically higher cash flow and potentially higher exit. And that's a risk reward calculation I was talking about.
Hey, Al, we have a question in the chat. Do you have a sample from past projects and ROI?
So every project is different. That's the only thing about oil and gas. Depends on, but I can bring a use case and send it to the group here. We were looking at a project where ROI was in the 250+% over 5 years. We've looked at other projects where it's the cash flow is really nice and consistent, above 25 to 30% a year. We've seen other projects where it's more like normal returns, around 15 to 18% year on year. And that's why I didn't put a use case to kind of mislead, because every project can be different, depends on the risk profile. But I would say it is typically 2 to 3x of what you see in real estate.
Oh, one more question. What is the percentage of obtaining positive oil results?
Sure. Typically, if you work with a very reputable research team in terms of the geology side, a very good, successful geology research produce 60 to 70% success rate of finding the oil and finding at the levels that they thought they would be at. And what happens in oil and gas is it's multi-well development. So if you only drill one well, that's not necessarily going to be a smart strategy. What's smart is to drill all the prospects and find, say, prove that 70, 80% of the wells are what they are, and then develop that side of it. So that's why you see oil and gas projects now make more sense, less riskier than they used to be. They used to be, let's drill 1 or 2 wells, and your success rate will go down to 30, 40% because, every well is 50-50 if you want to play statistics. But once you drill, let's say 15, 20 prospects, and you understand that 15 of them are great, now you develop based on the 15 wells, and you drill, let's say, another 30, 40, 50 wells, and you de-risk the development that way. So I would say a good analysis produce 60 to 70% success rate. And then from that, if you accumulate multiple wells around the ones that are successful, it increases the chances of going up.
Right. And then a follow-up question on that. What is the revenue percentage in the case of positive results?
That's what I was talking about. Oh, so positive results, revenue percentage, I would say the cash flow would be 10 to 15 is a good use case. It can be 20 plus on a yearly basis. And then the exit can be 2 to 5x. It depends on, what company come and buy that field at the exit. But cash flow on its own is very strong. Cash flow on its own is much stronger than real estate. So I would say cash flow, if I want to be conservative, is in the 10 to 15% yearly. In real estate, it's now 6 to 8%. And then exits in real estate can be 60 to 70%. You go to oil and gas, it can be 2 to 5x, but it's not as guaranteed as real estate because now you're still waiting for that oil and gas company. So normally when we go to an oil and gas project, the way we assess the risk is we make sure that the project on its own produces strong cash flow, and the exit is a bonus. So we project everything based on cash flow, and that's what we can control. And then exit is a bonus. Now exit can be phenomenal, but we treat it as a bonus. In real estate, we rely on both. We rely on cash flow and exit. How much does drilling a well cost? Great question. The answer depends. Vertical, simple wells that are not too deep, to Raed's point, they can cost $2 to $3 million a well. Deeper wells can cost more, maybe $5 million. And there's a concept of horizontal well, where they drill one hole and they go 90 degrees to hit multiple pay zones. Pay zones is where the oil is. And a horizontal well can be $25 to $30 million a well. So this is when we look at a project in oil and gas, and let's say we're going to raise a fund of $50 million or $100 million. We look at how many wells we're going to drill versus how many prospects we have. and how much money we're going to inject to get some cash flow out of the oil before we drill more wells. So we're not going to just go drill all the wells and wish for the best. We're going to drill the ones that makes more sense, get some cash flow out of that, and drill more wells. The other thing that is nice about oil and gas, because it's a higher risk, higher reward, very specialized, financing for oil and gas is less friendly than real estate. And so there are more chances to do all cash projects or low leveraged projects in oil and gas, which also reduces some of the risks on the financial side. When do you expect to have a new project? Again, the answer depends. I normally like to say within a maximum of 2 to 3 months is normally the window we look at. I've been actually actively working on a couple of projects since January, but we haven't gotten to a point where we can make them public to the investors yet.
As a reminder for those that are in Houston, Al, correct me if I'm wrong, but the last Wednesday in May, we're going to have our monthly meetup. Is that right?
Yes. So for the local folks, we do a monthly meetup in the last Wednesday of every month here in Cypress, in the northwest corner of Houston. And we'll continue to do our monthly webinar series, more on the education virtual side, every second Tuesday.
That's right. So if y'all want to stay up to date on what we're doing, some of the investments that are going to be coming up, or the educational opportunities that we try to provide, you can scan that QR code, or you can go to our website. You can also email either one of us if you have our information, so we can make sure to get you guys connected, because we really believe in the value of partnerships and of community investing together.
Awesome. We have one more. How confident are you on finding oil? We did cover on that. I would say the research normally proves 60 to 70%, but you still have to drill the wells. And we de-risk not finding wells, not finding oil in certain wells by drilling a collection of well in that and a collection of prospects. Thank you, everyone. Appreciate it. We'll see you next month.